Hey everybody, Chad Pavel here from Pinewood Consulting and StartFundGrow.com. Today I want to talk about the difference between debt and equity financing for your business. That's always the question. How do you finance your new business and how do you finance existing growth, expansion, acquisition? What are the differences? So the funding or financing world can be broken into primarily two categories, debt and equity. And so I've created this chart that gives a side-by-side comparison of the advantages and the disadvantages for you as a founder or business owner of two different types, the debt and equity structure. So let's look at the first one, the time to raise. Typically, it's easier and quicker to raise debt than it is to find an equity investor. You can go to a bank, there are online lending companies, there are credit cards. You can get many forms of debt financing rather quickly. Cost of holding the capital, 5, 10, even 20% interest rates on short-term debt and 8 to 10% interest rates on, say, an SBA loan are very affordable when you think about the differences of and compare it to equity raising. Or if you have an equity partner, they're very likely going to want a percentage. The definition of equity is they purchase a percentage of the equity, the shares, the stock, the ownership of the company. And that can be very, very expensive if you sell your business and someone else owns 20% of it. That's 20% of the proceeds going to them. Where with debt, it can be much, much different and much less expensive if you did have a loan on the business. So cost of holding the capital, the cost of raising the capital, again, it's typically easier and cheaper to raise traditional debt than it is to raise equity. Much more difficult to find private investors who understand your business and who will underwrite your deal. Dilution to owners. Debt is very favorable. It does not dilute your business. If you have a straight equity or straight debt deal like a loan, you will pay the loan back plus interest. It doesn't typically come with any component of equity or ownership in your business. Now, if you get into some of the more convertible or some of the more intricate debt instruments like convertible debt, like venture debt, they may come with some equity components to them, so just beware of that. Available to lifestyle and family businesses. Well, debt many times goes well with a family business. A good, fundamentally strong, growing business many times can use debt. It doesn't need an investor. Equity investors are typically best for startups that don't have cash flow. They are best for high growth potential companies, not necessarily the one-man shop, the sole proprietorship, the business that is just growing organically or on credit cards. Now, when it comes to getting a loan, personal credit, financial history, you need to have a strong credit score, a strong credit profile to get a loan of most types these days. With equity, you often don't need to have a credit report run, or the value of the investment is not necessarily based on you as a personal guarantor or your credit profile. It's based on the business potential many times. Investors place less weight on your personal credit score than banks. That's tried and true. Liability to founders if the business fails. Not advantageous to founders or owners. If your business fails, many times you'll need to pay that commercial loan back, and you will many times need to personally guarantee it. Most equity investments do not come with that type of arrangement, since the equity investors own the company as well. It's not a loan. Startup friendly pre-revenue. Very difficult to start a company with a loan because you don't have a product or revenue or cash flow yet. So if you have a $4,000 a month interest payment due on the 1st of January, but you haven't started to sell a product, how can you pay it back? That's where an equity investor can help you very much compared to a debt or a loan instrument. Investors to support or advise the business, smart money. Yeah, you'll definitely be able to get that with equity investors like angel investors or VCs. However, most banks and lenders simply want their payment back each month or even each week, depending on the type of loan you get. And that's often the extent of the interaction you will have with them is them communicating to you and you to them how well you're doing, and that will determine your ability to pay off the loan. Collateral and securitized instruments. Yes, commercial loans Also require, well, you can even go through the last three things. Many commercial loans, most commercial loans, SBA loans will require collateral in the form of cash, stock, bonds. They will require most definitely regular cash payments. That's the definition of a loan payment and an interest payment. And they typically will require a personal guarantee. So if you don't have significant cash or assets or collateral to put into the deal, you may have a lot of trouble getting a large loan, even if it's going through the SBA. So the way that you can battle that is to have more cash, equity. You can have a stronger credit profile. You can bring in a personal guarantor to co-sign on the loan. And you can obviously get your business running now with small amounts of debt or equity, and then use more commercial loans later to expand the business. So they're not the most startup friendly type of financing. Again, with equity, they're typically not collateralized or securitized. They typically don't require regular cash payments, and they don't require a personal guarantee in almost all cases. So that'll do it for today, the debt versus equity financing chart. I hope this helps. We've included some links below so you can check out the sites and see some more resources. I'm Chad Pavel. Have a good day.